Hello and welcome to this video. Often on YouTube you'll see 3 stocks to buy, 5 stocks to buy this stock. And I've even done a couple of those videos myself. But actually what I'm learning, particularly from Terry Smith's book, is that the best way, or rather one of the best ways to maximize your return, is to trade as infrequently as possible, thus minimizing costs. So what I thought I'd do is actually look at 2 stocks that I didn't buy. Two that on the face of it look like quite good purchases, but actually I haven't bought them. And when I'm talking about buying stocks, I'm talking about my portfolio challenge. I will have a little bonus for you at the end, actually, which is one stock that I'm really close to buying. But the focus of this video in the main will be on those 2 stocks that I reviewed and didn't actually buy. So thank you for joining me. And if you are new to my channel, the key focus here for me is I've got a target of £1 million my investment portfolio. I want to hit that £1 million ideally by 2050. I'll continue to provide monthly portfolio updates for progress on that, but based on the current level, that means I need to make 9.5% per year for the next 27.5 years in order to hit that £1 million target. So that's the background figure in mind. I need to be making 9.5% from this point going forward, assuming I only put the minimum £300 a month in. So my channel is about charting that journey over a long period of time as I move towards that target, hopefully. So that's the plan. So 2 stocks I didn't buy for the portfolio and one I'm very close to. Let's jump into the screen and have a look at them. So the first position I was looking at is Tesco. Tesco is a UK company, so retailer, a very well-known company in the UK. And the reason I was interested in Tesco was that the chance of them going bust is almost zero. So rule 1, don't lose money. I think Tesco satisfies that point. Now the second thing is the dividend of around about 4%. I thought actually if I can get a little bit of capital appreciation and get the dividend as well, that could help me with my return. And if you look at the chart for the last 6 months, Tesco was touching almost £3 and we're now at £2.60, although it did drop almost to below £2.50, which is what kind of triggered my review of them. So the view is that Tesco will go for 12% a year for the next 5 years, at least for the analyst part on Yahoo. And I need 9.5% a year, that's 25 years plus. If I get more than 9.5% a year, that's great. Now, if Tesco's going to grow at 12% a year, and we think the shares are fairly valued at the moment, then that suggests that Tesco could provide a return of around about that region. Warren Buffett says the market is a popularity machine or voting machine in the short term. Long term, it's a weighing machine based on the actual results. They're growing earnings 12% a year. You'd expect the share price to go at 12% a year, all other things being equal. Now, we know it's not quite that simple, but that's the theory. So I want to look at the ticker terminal, which is a new site that I found. I'm just using the free subscription at the moment. It's pretty useful. You can see multiple years of history, and there's a huge amount of data on here to look at the more detailed listings. It's quite a useful tool, particularly as Morningstar's taken away their 10-year history for companies. That's no longer a service that's provided, so this is probably the other way to get some of the historic data. My first thing to note with Tesco is they are very small gross margins, single-digit percentages, always less than 7%. But as a mainly food retailer, you would expect low margins. So that's the first thing. Do I want a lower margin business? Now, they are profitable. There is positive net income every year, which is great news. See here the repurchase of common stock. They have spent many hundreds of millions of pounds buying back shares. So in theory, that creates value. However, it depends on the price that that's done at. But actually thinking about, again, referencing Terry Smith, Investing for Growth, which is a great book I've just finished reading. I really recommend it. Actually, what we really want is the highest level of return on capital employed, because that is the return the company's making on the money it's putting to work. Now, if it's buying back shares or giving out dividends, it's not actually reinvesting that back into the company. And that's effectively what the return on capital employed is telling us. The free cash flow for Tesco, there have been some negative numbers here. 2020, 2021. Now, presumably that was due to pandemic-related reasons, because it's otherwise been over £1 billion. Market cap of Tesco is about 20 billion. On that basis, you're not going to say here it looks really cheap based on free cash flow. So looking at the ratios, which is why I love this, it's got all these ratios with the historic versions. Return on capital is less than 10% every year. Look at 9.1% for the most recent period. And Charlie Munger says that if you look at return on capital, if you hold a company for 40 years, they make 6% return on capital, you're probably going to make 6% return, regardless of other factors over a long period of time. So actually, based on this, I'm not going to get 9.5% return from Tesco because the maximum value they've got here is 9.1%. And of course, there's no margin of safety in that, even if 9.1 was the value I was looking for. So that's why Tesco isn't a buy for me. This return on capital figure is not big enough. Now, this is kind of a newer thing for me to look at, so I'd be really interested in your thoughts on this. Now, I used to always use return on equity, which again is a good figure, but the return on equity can be skewed somewhat. Because if you reduce the amount of equity, make your return on equity look bigger. Now, of course, for Tesco, this is not a recommendation to buy, sell, or hold. I'm just giving my view on the company, so not investment advice. That's the usual disclaimer. So a very quick interlude before we go on to the next position that I didn't buy. I'd really appreciate it if you please consider joining me on this journey. Thanks for watching so far. I hope you found it really useful. Number 2 is Royal Mail Group plc. Now, Royal Mail is a very interesting one. Look at the last 2 years. They were down as £1.72 all the way up to almost £6. So there's a great run up there. And there's a lot of boost from pandemic. So I should say, sorry, if you're not familiar with Royal Mail, they're the logistics and delivery company. The only company that has to deliver letters, legally speaking, to every single property in the UK. So they've got scale, and they've got a lot of assets. So this absolute run up here, due to the pandemic, more people at home, a lot more ordering and e-commerce, a lot of testing kits, they really benefited from that. So if you were clever enough to foresee that, then you would have made a good amount of money. I was not clever enough to foresee that, quite the opposite. They then dropped down, and we're down at sort of £2.79 here. And it has been pretty much as low as £2.50. The reason it's interesting to me is because it's run back down again. The second reason it's interesting to me is the price to book of 0.5, which suggests Royal Mail is priced at half the value of its net assets, essentially. So that sounds good. And those P numbers are very low. Now, that can, of course, mean a very slow-growing business, but it can also mean sometimes the market hasn't appreciated the company. And actually, it is a small cap well, I'll say small cap. It's not a very big company. It's a couple of £1 billion. And despite the scale of Royal Mail, well over 100,000 employees, probably close to 200,000. And then finally, the dividend, forward dividend, according to this data here, of 7%, so 20p. And you compare that to the share price. So those are the 3 reasons why Royal Mail is attractive. It's run down, the book value, and then the dividend. For income statement, we see high gross margins, sort of around high 30s to 40%. And we see profitability 2018, 19, 20, 21, and 2022. So consistently profitable company making hundreds of millions of pounds of profit. Now, 2022, you can see that profit's jumped up to 620 million. You compare that to the market cap. That's why that PE looks so good. Of course, it looks so good, but it's going then from 4 and a bit to almost 7, because presumably the earnings therefore forecast to decrease. And look at these payout ratios, 90%, 138%, 150, 27%. The payout ratios are all over the place. Normal dividend per share has been all over the place. So it's not necessarily the most reliable dividend stock, although the dividend has been good. Now, if we look at the total assets of Royal Mail, we're looking at sort of 10 billion, but the total liabilities, sort of 5 billion. So this is the gap between the two, just over 5 billion. Market cap just over 2.5, so that's why you've got the price to book of 0.5. So most of these assets are in the plant and equipment. So it's all these properties they've got all over the place. So as the property market's been going up consistently for a long period of time, they've benefited from that on the balance sheet. So they're looking interesting so far. Look at the cash flow they're making, cash from operations, 1 billion in 2021, 1 billion in 2022. There has been repurchase of common stocks, there have been share buybacks. Let's hope they did them at £2 and not £5. So let's have a look at the ratios. Return on equity has been going up, but most importantly, return on capital. So you look at 6, 10, 4, 13, 10%. Fluctuation. These aren't like massive numbers. Yes, some of these numbers are above the run rate I require from today of 9.5%, but again, not much margin of safety. I think there's a very strong argument by Royal Mail based on the book value. But we're not actually buying an amazing company here. We're buying a good company that's profitable and doesn't have much debt. We're buying a company that makes an okay return on capital. This isn't a great company. So I think if you're looking for a decent dividend stock, there could be an argument to buy here. But again, for my portfolio, I want to try and get those best companies in. So Royal Mail, based on that, isn't the sort of company that's going to materially improve the returns in my portfolio. It will give me a very high probability of getting 9.5% a year or more over a very long period of time. Particularly that there's been some news recently around most of the members likely to strike. We know that there's less testing and that sort of thing going on, so some of that income's actually going to drop down. It just doesn't quite feel like the story's there for Royal Mail at the moment. It's close because of the book value and the dividend, but I think for my portfolio, it's all about this return on capital, and I'm going to be focusing a lot more on that going forward. I just don't think Royal Mail at the moment is quite right. So thanks for sticking with me. Now, one position that I'm considering adding to my journey to the £1 million portfolio is Somero Enterprises. Market cap about £250 million, a small company. Most of the business is in the US, but it's actually registered in the UK. So what attracts me to this? PE's in the single digits, caught my eye. That doesn't mean it's a good buy, but just caught my eye. It's the first screening. And the last year, the price has increased to £6 or so per share and dropped off to sort of £3.60. So that's really caught my eye. It's shot up briefly to £4.20 in the last few weeks. And also, this has got a dividend on it of sort of 5 to 6% here. Then I did see a return on equity of 50%, return on assets 32%. So this is now looking a bit more interesting, right? When we look at the revenue in recent years, that revenue net income is always very high, proportion to their revenue in particular. Free cash flow, 23 million, 16 million, 27 million, 31 million. So big free cash flow numbers against the market cap of 230 odd million. More than 10% of the market cap. So that starts sounding interesting. Return on capital employed 3 years ago was over 50%. It's still over 50%. Return on assets is high, much higher than industry. Return on equity is high. So these numbers are the really interesting ones. So when they reinvest into their business, yes, they pay a dividend now, but when they reinvest the remaining money into their business, they make great returns from that money. So that's a very powerful way for business to compound. Look at the financial health. That balance sheet is flawless. There's no debt here. And they've got loads of cash. They've got cash of 15% of market cap, possibly more. A little bit of inventory. Yeah, there's nothing negative here. Dividend, you can see here. Dividend in absolute terms is the sort of light coloured line. You can just see that creeping up. But it's a very nice trend indeed. Payout ratio is fine, but it potentially could get quite high. So we just need to watch that. Dividend's probably not likely to increase. It may even have to drop back a bit. Got really much analyst coverage on this one, so that is good to see. So Wall Street hasn't discovered this stock yet. It's very small. It's £250 million, so probably why would they? So I'm looking at this one. If you've come across them, I'd love to hear your comments below. If you're thinking about buying them for your portfolio as well, yeah, let me know what you think. I want to hear more opinions on it because, of course, there's definitely things I can miss. But I'm doing a bit more research into them, and then potentially they do look stronger than some of the companies in my portfolio at the moment. So therefore, that could be a good purchase. If you found this a useful idea, please consider hitting the like button. I'd really appreciate it. It helps spread the video. So to find out what stocks I did buy for my journey, do click the box on the screen that's appearing now. And if you're struggling to get your investing started and you're looking for ways to try and optimize your finances to get to that point, then great news. You click on the other box that's on screen now. There's the book that I think really could help you on that journey.